Next, trading on the markets last week was volatile as investor sentiment swung repeatedly between positive and negative. This was mainly due to conflicting headlines about U.S.-China trade disputes, which have been a major driver of market volatility in recent months. Also, signs of more interest rate cuts, as well as the government shutdown, all present conflicting investor narratives. Joining us to make sense of it all is Bob Rubin. He's founder and president of Rubin Wealth Advisors. Thanks for joining us this morning, Bob. Can you break down last week's market volatility?
Good morning. Thank you. Yeah. Last week was kind of crazy with all the different trade strategy coming out against China. We had there was different earnings, a few that came out on that. And also there's just this heightened tension between U.S. and China and a little bit of the shutdown. I'm not so sure that the shutdown has as much to do as some people are saying. I think actually the shutdown, with the exception, unfortunately, of people that are losing their jobs, is less important to the American consumer than most people think.
Yeah, could you go a level deeper on that? Obviously, very much people who are missing paychecks, especially if they don't have cash reserves, are feeling that personally. But how does that affect the more macroeconomic outlook?
Well, I think that's the point, is that I'm not so sure that it affects it as much as people think it did. I think the Council of Economic Advisors came out of the White House last week and said there might be a $30 billion drop in consumer spending if the shutdown lasts a month. I mean, $30 billion is not that much money. So I'm not so sure. And I think most of that actually has to do with the lost income of federal workers. So I really don't think that the shutdown is as much of a national crisis as people say that it really is. And I think that the president is doing a good job of using it. He's riffing people, reduction in force, and he's using it as a way of adding some more efficiency to the U.S. government.
Yeah, then let's pivot over to where most likely the biggest source of the volatility stems from, with China and the trade war. Trump, the negotiator, tends to make these very bold, extreme statements when U.S. interests are threatened. After the critical rare earths were restricted by China, his initial response was a huge increase in tariffs, and then he canceled his meeting with Xi. But then very shortly after, the meeting was reinstated, and Trump was kind of lessening the effect, offering a warmer tone. Are the markets sort of becoming more used to Trump's negotiating style, as we saw last week, in contrast to what we saw last spring when the initial breakout of the tariffs were announced?
I think a lot of people are now reading The Art of the Deal, which is this is some of his strategy and the way that he negotiates these deals. But unfortunately, I think some of this strategy does hurt these companies. I mean, some of these tariffs are 100% right now, and we have clients that are writing very large checks to the government because of that. They have no choice but to get certain products out of China, for example. I do think you're right, though, that a lot of investors and companies have gotten used to the sort of the up and down, and they're ignoring a lot. I don't know if ignoring is a good word, but they're not paying as much attention to some of the day-by-day ups and downs that in the negotiations that Trump does. But it is affecting a lot of companies. These tariffs are definitely affecting a lot of companies and the amount of money that they have to pay right now.
And Bob, as we look at people who are trying to figure out how to manage their own investment portfolios, these large swings and this volatility creates opportunities for institutional and day trader types. They have different goals, of course. Some trying to get in on maybe opportunities that were too inflated, and then there's a correction and they move in. But how does that affect, sort of your average investor who has a more long-term goal?
Yeah, the biggest problem with the average investor who has these long-term goals is that they get emotional here and they get a little freaked out and they say, oh man, the market went down 10%, 15%, or one particular position in my portfolio went down, and they want to go out and sell. And that's just generally not a good idea. So most advisors like ourselves work very hard from a psychological standpoint to give people some confidence so they don't sell at the wrong time. Because look, if you have a capital gain and it goes down a little bit, you don't sell it, even though it might show a capital loss, then you didn't recognize it, so it doesn't hurt you. Just a lot of times you just want to hold on until that position of the portfolio comes back. But sometimes it's very emotional. It's a very hard thing to do. And that's where advisors like myself come in.
Yeah, Bob, so let's play that out. I'm one of your longtime clients. I don't have a huge amount of money, but enough for my retirement. And then I call you, I say, hey, I read these headlines, I'm freaked out, I have to throw a big wedding for my daughter in the spring. Should I sell? You say?
Well, obviously, the money that's invested in the market is longer term money, right? Like you don't want to have that money for your daughter's wedding, or you have to buy a house next month or something like that. That kind of money you should have put aside in a short term money market account, just getting interest, and it's good. It's not affected by the market going up and down. So with that, I would hope that I wouldn't get that call, because I hope as an advisor I would have said to you, hey, I know your daughter's wedding is coming up. I know you're going to be spending a lot of money on that. I know we don't want to disappoint your daughter, so we want to have the money put aside for you. Well, we're good for that. But the other money, we really want to make sure that this money for investment, I mean, for retirement, 10, 20, 30 years out, you're going to have a lot of ups and downs. There's going to be a lot of things that are going to happen. There's a lot of macro events that are going to occur. You're going to have war. You're going to have recession. You're going to have depression. You're going to have all sorts of things. You're going to have trade wars. You're going to have China coming in and Trump fighting them and all this stuff. But you have to really learn to shut that off. But for most people, it is very, very difficult to do that. And yeah, if I turn my phone on now and I look at the text from last week, people do get nervous. And we work really hard to sort of calm them down, and everything is going to be okay.
And Bob, just as we finish up in our last 30 seconds, another factor that's coming on, interest rates have already been cut, and it looks like more are coming. What should people be mindful of if they're parked in money markets and high yield savings now that the interest rates look to be coming down in the foreseeable future?
So I have a little bit of a contrarian nature on that. That's a really good question. My position on that's a little different, because last year when Powell cut interest rates, remember, he just cuts the Fed funds rates, interest rates actually went up. And last month when he cut rates, in anticipation of that, rates went down a little bit, but not a lot. And so I'm not so sure that we call it the arrow in the quiver, that if he does cut rates again, which they're talking about 25 basis points before the end of the year, that it's actually going to bring rates down, like the rates that are meaningful for us, which say is mortgage rates. So in that case, when you ask about money market, I'm not so sure the money market rates are really going to come down that much. The good ones are still over 4%. I suspect, and listen, when you predict interest rates, it's a bad thing, but it's really hard to do, if not impossible. I don't really see short-term interest rates coming down by much that are going to affect your money markets.
Good to know. Good advice always. Appreciate that. Bob Rubin, thanks for joining us this morning.
Thank you.